Good afternoon and welcome to this fingraphs.com podcast on Dukascopy TV. Today we're going to look at our cross-asset views into early next year and to equities and risk assets, which we think are still uptrending. We'll first start with a cross-asset Mosaics on our fingraphs.com platform with weekly charts on the upper line, so the perspective over the next few quarters, and daily charts on the lower line for the perspective over the next few months. What we can see here is that the S&P 500 is still uptrending. It is slightly under stress with both envelopes are touching each other, but our targets are still pointing towards 3,800 over the next few months, and our risk index is not overbought yet. On the daily graph, we're slightly overbought at the moment. It may see a bit of a correction over the next week or so, we believe, but then should rise again into early next year, possibly towards mid Q1, and potentially, and you can't see it here, but up to 4,000. The euro had seen a consolidation, quite a strong consolidation between 2018 and early this year, with most cyclical assets, and central banks intervene in March, has been accelerating higher. It made it above our resistance around 120, is now probably heading towards 127, 132 over the next few quarters. Shorter term, we are under stress a bit with our envelope, so we could expect a bit of consolidation here. We've reached our targets, but our risk index still leaves some leeway for further upside over the next few months. So maybe a bit of high-level consolidation here, and then further upside into the spring. Treasury notes, in our view, are still in an uptrend, which means yields are still in a downtrend, and that uptrend probably extends into next spring. Yet at the moment, they are still quite overbought and have been consolidating down since August. This consolidation down is probably not quite finished yet. It saw an intermediate low early last month. We had a rebound. We could probably see a bit more rebound over the next week or so some retracement on rates short term, but we should then continue in this consolidation possibly into January, perhaps early February. We don't believe we're going to see much downside here, so not much upside on rates either. Rates are probably capped around 1.2% on the US 10-year. And the risk index has already come down quite a bit, is perhaps even already turning up. So we don't expect anything very, very strong to the downside on Treasury bonds or to the upside on yields. But for now, the consolidation is still underway. Looking at gold, it's a similar picture. It's still in an uptrend. We believe it probably also lasts into next spring. Our impulsive targets have been reached. We believe we could probably reach our impulsive 2 targets to the upside between 2,200, 2,400. The risk index does leave us indeed some leeway to the upside. It's not quite overbought yet. We've seen quite a strong correction here over the last few months. We believe that we are finding support, if not already soon, and that we could gradually resume the uptrend into the spring. We can see a similar consolidation as we have here on the Treasury notes here. We probably saw an important dip about a week ago, and we have since been rebounding quite nicely. The reason why we're a bit more positive on gold than on Treasuries is that if Treasuries don't really fall but are still in consolidation, but if the euro does indeed accelerate to the upside, this will act as counter effect, and gold should benefit from it more than Treasuries. So probably gold should rise as the euro rises and the dollar weakens. We wanted to end with 2 more charts, one comparing a defensive sector, so US consumer staples sector versus the S&P 500. And what we could see is that it had been rebounding between 2018 and early 2020 with the cyclical downturn that we indeed saw, that we saw previously on the euro US dollar. But since the Fed intervened earlier this year, defensive sectors have been underperforming. The risk index is still very much in the middle of the range. It is in a downtrend, and we believe that there's further downside to come over the next quarter or so, and probably down to an oversold area sometime late Q1 and this spring. What we can see is that on the daily graph, we are in a downtrend. We're a bit oversold at the moment, but so we could see a slight bounce, but we believe this downtrend probably continues into early next year in first instance. And on the hourly graph, yes, a bit oversold, could see a slight bounce, but it's still very much a downtrend. So if defensive sectors continue to underperform, that means equity markets continue to rise. Finally, we wanted to look at another ratio which compares the all-country world index, so international markets, versus the S&P 500. We could see that they've seen quite a nice rebound since earlier this year, in line with the rebound we saw on the euro US dollar. We're now getting towards resistance, and you may see a bit of work around these levels. The daily graph is in uptrend, still has some upside potential, but is also a bit overbought here. So you can see a bit of retracement here, possibly over the next week or so. But in general, if international markets follow the euro higher, we should then break out above this resistance, and with possibly some nice upside into next spring. Shorter term, we also a bit overbought, could see a bit of consolidation, but all this configuration suggests a buy the dips opportunity into perhaps mid-December on international markets versus the US. We thank you very much for your attention and wish you a very good week of trading.